Every empire swears its money is safe and its currency is strong. Every government believes its promises will last forever. And every time, history proves them wrong. From Rome to France, from the United States to modern Lebanon, people have woken up to find that the savings they spent years building had become worthless, their salaries meaningless, and their futures stolen by systems they thought were solid. Collapse is not occasional. Collapse is reality. The real question isn't whether financial systems fail, it's how we protect ourselves when they do. The illusion of permanence is the most dangerous financial mistake you can make. We look at our bank balances, our savings, our national currency, and assume they are guaranteed. But money is not guaranteed. Money is trust, and trust can disappear overnight. This is why history is both merciless and incredibly useful. Every collapse leaves behind a pattern, a set of lessons about what actually protects wealth and what turns to dust. And if you pay attention, you'll see that the ones who come out of these disasters intact are never the ones who trusted the most, but the ones who noticed early and doubted first. Take the Byzantine Empire, remembered as the eastern half of Rome, that somehow survived 1,000 years after the West fell. At the center of its economy was the gold solidus, a coin so reliable that merchants across Europe, the Middle East, and Asia accepted it without hesitation. For centuries, it was the closest thing the medieval world had to a global reserve currency. You'd expect that they would have learned from the collapse of the denarius. The Roman silver coin emperors had debased until it was practically a silver-plated tin token. But no. Centuries later, the Byzantines repeated the same mistake, this time with gold. They began reducing its purity, thinning it out, adding cheap alloys that destroyed its quality. At first, no one noticed. And then confidence shattered overnight. The currency that held Mediterranean trade together became nothing more than a political tool. Its loss of value destroyed its credibility, and the Byzantine economy lost the stability it once had. So what survived? Not imperial promises, not government decrees. The merchants who quietly held real gold or land beyond the emperor's reach protected their wealth, while everyone else watched their savings evaporate. This is the first and timeless lesson. Governments cannot resist the temptation to debase their money, and when they do, real value flees to assets they cannot fake. But not every collapse comes from rulers tampering with currency. Sometimes the shock comes from places no one expects. In the mid-14th century, Europe was struck by the deadliest pandemic in history, the Black Death. Between 1347 and 1351, nearly half of all Europeans died. Cities emptied, villages vanished, trade routes crumbled. And yet the economic story of the pandemic is far more complicated than a simple disaster. Because when half the labor force disappears, labor becomes valuable. The survivors could demand higher wages. Food and land, once scarce compared to people, became relatively abundant. Families with liquidity, silver, gold, goods, or even just the ability to work, suddenly found themselves with advantages they could never have imagined. Land that once cost a fortune could now be bought cheaply. Houses stood abandoned, fields unfarmed, and the survivors were in a buyer's market. If this sounds strangely familiar and frightening, it should. We saw a modern version during COVID. Supply chains broke. Governments printed trillions to keep the system alive, and those with liquidity bought assets while those living paycheck to paycheck fell behind. Inequality exploded. In the United States, home prices surged, the stock market snapped back almost instantly, while millions struggled just to pay rent. The pattern is clear. Pandemics redistribute wealth. They always have. The survivors of the Black Death used scarcity to climb the social ladder. During COVID, people with liquidity bought homes, stocks, and businesses others could no longer afford. The lesson isn't comforting, but it's real. Crises reward those with reserves and crush those without them. And while pandemics show how quickly shocks can flip an economy upside down, the banking collapse in Renaissance Florence reveals something just as important. Institutions that seem too big to fail can topple like dominoes. In the 1340s, Florence was the financial capital of Europe, home to powerful banking families like the Bardi and Peruzzi. These bankers lent enormous sums to kings. the most catastrophic being the huge loans to England's King Edward III during his wars with France. When Edward stopped paying, the banks collapsed. Depositors were ruined. Trade halted. Florence, once rich and powerful, plunged into chaos. Ordinary citizens who trusted these mighty banking families learned a brutal truth. Size is not safety, and reputation does not offer protection. What did people learn? That too big to fail is one of the oldest lies in finance. Institutions exist to make money, not to keep you alive. And when they collapse, they take your savings with them. From Florence's fall to Lehman Brothers in 2008, to the frozen bank accounts of Lebanon in 2019, this lesson repeats every century. Survival belongs to those who understand that a bank's promises last only as long as the bank itself. The American Civil War is remembered for battles, politics, and the end of slavery. But behind the smoke and speeches was a brutal financial war most Americans today never think about. Both the Union and the Confederacy realized that a conflict of that scale required printing money. In the North, the government issued greenbacks, paper money backed not by gold, but by the word of the United States. At first, the experiment seemed bold and patriotic, but the more greenbacks entered the economy, the less they could buy. Inflation eroded their value, and confidence broke. In the South, it was even worse. The Confederacy printed enormous quantities of graybacks to fund the war. By the end of the war, Confederate inflation had reached unimaginable levels, prices rising by the thousands of %, wages buying almost nothing. Soldiers' pay lost its value before they could even spend it. Families carried bags of bills that couldn't buy a single loaf of bread. By 1865, Confederate money wasn't just weak, it was dead. What mattered in that collapse weren't promises, but physical assets. Land, food, gold, silver, anything real, held its value, while money became a cruel joke. For ordinary Southerners, it was devastation. Lifelong savings evaporated. For those with access to hard assets, the war became an opportunity to acquire land and property for pennies. The forgotten lesson for Americans: the country has already experienced a total currency collapse. And when it happens, protection does not come from trusting the cash in your wallet, but from holding what inflation cannot destroy. France offers a brutal example of how revolutions can destroy money faster than any war. In the 1790s, after toppling the monarchy and seizing church lands, the revolutionaries issued a new paper currency, the assignat. In theory, backed by confiscated property, it was supposed to stabilize the economy. Instead, the government printed it endlessly. Each new issue diluted the last. Prices exploded, wages fell behind, and the assignat became worthless. Farmers refused to sell food for paper. They wanted goods or silver instead. Bread riots returned to Paris, and the revolution devoured itself. The winners of this collapse weren't the patriots holding government paper, but those with food, gold, silver, or property, things the state could not print. The lesson for ordinary Parisians came too late. Even the highest promises are worth only as much as others are willing to accept. When trust dies, savings don't shrink, they vanish. Skip forward 2 centuries, and the lesson reappears in Asia. In 1997, a speculative attack on the Thai baht triggered a regional crisis. Thailand had borrowed massive amounts in dollars, confident that its currency peg would hold. When the peg broke, foreign currency debt became unpayable overnight. Investors fled. Currencies across Southeast Asia, Indonesia, Malaysia, South Korea, collapsed in a chain reaction. Economies froze. Unemployment soared. Governments begged the IMF for help. The ones who suffered most were not the hedge funds that sparked the panic. It was ordinary citizens whose savings lost value, whose mortgages exploded, whose jobs disappeared. Yet the pattern was painfully familiar. Those who held dollars or foreign assets survived far better than those who trusted local currency. Countries reliant on foreign debt were forced into austerity, while Wall Street scooped up Asian assets for pennies. What looked like a local collapse was really a global wealth transfer. The lesson, shouted across every collapse from Byzantium to Argentina, is simple. Borrowing in someone else's currency is a death trap. When the storm comes, it isn't the lenders who drown, it's the borrowers. By now the picture should be clear. Whether revolutionary France, Civil War America, or modern Asia, the same story repeats. Paper money collapses. Debt enslaves nations and families. And survivors are never the ones who trusted systems the most, but the ones who recognized fragility before it shattered. The terrifying part of history is that collapse isn't just something from the past. It is happening right now. Between 2019 and 2021, Lebanese banks did something people in the modern world still struggle to believe. They locked their doors. Citizens went to sleep and woke up to frozen deposits, withdrawal limits, and a currency collapse. The Lebanese pound lost over 90% of its value. Lifelong savings became pocket change. People lined up outside banks begging to access their own money, and were told it was gone. Not just small savers. Middle-class families, retirees, doctors, engineers, everyone who trusted the system was wiped out. The lesson is brutal and clear. The money in your bank is not a treasure chest. It is a loan you've given to an institution that may decide not to repay you in a crisis. The people who survived best were those who diversified abroad, held gold, silver, or property, or kept cash outside the banking system. Everyone else was trapped. If this feels distant, it shouldn't. In 2008, Americans watched their homes foreclosed and their pensions shrink, while the banks that caused the crisis were rescued. In 2020, governments printed trillions to keep the system alive, a lifeline that multiplied asset prices for the wealthy, while ordinary wages barely moved. In 2023, regional banks in the U.S. collapsed almost overnight when depositors lost confidence, reminding everyone that too big to fail is just a story we tell ourselves until the doors close. So how do you protect yourself when everything falls apart? History shows there is no single answer. In Byzantium, it was gold. After the Black Death, it was the liquidity to buy abandoned land. In Florence, it was refusing to trust too big to fail banks. In the Confederacy, it was hard goods. In France, it was food, land, and property. In Asia, it was avoiding debt in foreign currencies. In Lebanon, it was getting out of the banks before the doors shut. The examples change, but the principle never does. Survival doesn't come from blind faith in paper or institutions, but from recognizing what holds real value when illusions collapse. And here's the paradox you need to wake up to. Collapse is both a tragedy and an opportunity. For the unprepared, it is ruin. But for those with strength, liquidity, or assets that cannot be printed away, it is the moment to acquire wealth at a fraction of its former cost. After the Black Death, peasants became landowners because land was abundant and farmers were few. After 2008, those with cash bought homes while millions lost theirs. History shows that protection isn't just defense. It is being in a position to acquire what others are forced to abandon under pressure. But wealth isn't only what you own. It's what you can do. The winners of history weren't just those with gold or property, but those who could provide value when others couldn't. The baker who could still make bread, the craftsman who could repair tools, the farmer who could feed a town, the merchant who could move goods across borders. These were the people who didn't just survive collapses, but rose through them. In every crisis, money loses value. But production never does. People still need to eat, build, trade, and live. Those who can meet those needs never stay poor for long. This is the more subtle form of protection. Not blindly trusting institutions, not assuming governments or banks will save you, but combining real assets, real skills, and the awareness that illusions always fall. Every crisis is a transfer, from the believing majority to the prepared minority, from promises to tangible value, from passive savers to active builders. History has shown this pattern again and again. So the question is not whether everything will fall apart, because it will. The question is whether you will be among the many holding promises, or the few holding something real. History doesn't repeat, but if you ignore it, it will crush you. If this video gave you a new perspective, please subscribe. History has the answers. I'll show you where to look. This video is not financial advice.